Let's get right to today's market action. We have Paul Dietrich. He is Fairfax Global Markets CEO, Chief Investment Officer, who's expecting a market correction. He says it's going to happen, and he'll tell us when and where to invest to protect your money. Mark Tepper, Strategic Wealth Partners founder and president, couldn't disagree more. He's going to tell you how to position your portfolio before interest rates increase, but he is a big bull. And Larry Shover, joining us from the CMA. Larry, I want to start with you and talk about the effect of Apple. Was Apple, I know we talked about Home Depot pulling down the Dow, but kind of disappointment because of Apple. Might that affect overall indexes?
You know, it could have, but let's keep in mind that usually Apple goes down in price after some big announcement. The consensus was so wide and broad, and except for that iWatch, which we know the availability isn't until after the holidays, that was a real bummer to the market. Desk flows here were very quiet, and when that news came out, that surely didn't help a whole lot, because right now, traders are basically very anxious, waiting for next Wednesday's FOMC. With that in mind, any kind of news, especially something so big as Apple, could really affect the market. So I think you're spot on with Apple and the effect of the market right now.
Well, Paul, but if we looked at today's market action in particular, within the last half hour or so, you had a lot of volatility and really the Dow and the Nasdaq pushing the session lows. We somewhat came back. You're looking for a big correction. Did something happen today that kind of reinforces your belief that we're going to lose more points?
Well, I don't think 2 days makes a correction, but I do believe that we will see a correction in the next 8 weeks. And here's why. I mean, we're value investors at Fairfax Global Markets, and we can't find any value stocks that meet our screen. So there are just no undervalued stocks in this market. The second thing is September and October have historically been the worst months for performance in the history of the stock market. And lastly, earnings drive markets. And we have to remember that 53% of the S&P 500 companies and the Dow companies, their profits come from overseas earnings. And even though the U.S. looks good, overseas doesn't look so great. Russia's in recession. Europe is flatlining, maybe going into a recession. The two biggest other economies in the world, China and Japan, they're slowing down. That's going to slow earnings from those overseas sales, and that's going to affect the stock market here. And then you got all the geopolitical risk. I mean, President Obama is now taking his war with ISIS to Syria. What could go wrong with that? Nobody believes that the Ukraine-Russian ceasefire is going to hold. And next week, we're going to see Scotland vote for independence. And nobody really thought that Scotland would vote for independence, but now the polls are showing that they're going to win. And if that happens, you're going to see one hell of a party in Edinburgh, but the next day you're going to see a massive hangover in the stock
Paul,
markets.
I got to jump in because there's some people here opening windows. I'm worried they're about to jump out. Before that happens, I want to get Mark in the picture because he's a lot more bullish about the way things are going. And just to support your position, Mark, for a second, you look at those jobs numbers and you look at some of the depressing news that Paul was talking about, and that gives weight to the doves in the Fed. The September 17th meeting is going to be the battle again between the doves and the hawks. The doves want to put off interest rate hike until the last possible minute, and they are supported by all this bad news, are they not?
They are. As long as we're looking at a Goldilocks kind of economy where economic data is, not too hot, not too cold, monetary policy is going to remain easy. And as long as it's easy, that's going to support equity prices. There's a lot of concern that as soon as the Fed is done with its tapering process and it begins to raise interest rates, that there's going to be some huge market correction. And that's just simply not the case. Since 1961, when you look at average rates of return, given our current Fed funds rate cycle, which is where money is easy and the Fed is still easing, we're looking at annualized returns in this cycle of 23% a year. Next May or June, when the Fed does decide to potentially raise interest rates, we're going to move into that next cycle, which is where monetary policy is still easy, but the Fed begins to tighten, and mean annualized returns in that next phase are still a positive 10% per year. So, yes, a lot of the big gains are behind us, but there's still money to be made over the course of the next few years.
I'm sorry, but you know what, Larry Schober, if that's so true, then why do you have a lot of money managers and frankly commentary saying that they're looking overseas now? They're thinking that other parts of the world are going to be the places to put money, not the U.S. Why is that happening then?
I think it's all because of multiples. I mean, right now, our forward multiple in the S&P 500 for 2015 is about 15.5. I don't view that as being rich, but it's fairly valued. It's getting towards expensive. When you look at China, you're seeing sub 9%. When you're seeing Europe, when you're seeing Europe, you're seeing sub 15 times. So it's all just about divergence of the stock markets and picking up value. I mean, that's why when you look at China or Europe being just cheaper relative to the U.S. But I would say there's a reason for that, and that's because we are growing and our earnings continue to grow at 8 to 10% a year. So that's probably a good reason why our multiples are so high.
Paul, let me get you back in here for a second because you are positive about some things. Let's talk about energy in particular. I was just talking to a guy who's on the board of a couple of oil companies. He was ecstatic because now the fact that the United States is the top producer of oil in the world, and he thinks that after the election, we're going to get rid of this export ban. A lot of these companies that are producing oil domestically are going to be able to export that oil. If that happens, what happens to domestic energy producers here?
Well, the price of oil is probably going to go down, at least in the short term, just simply because we're at 28-year highs of producing oil here in the United States. Once we're able to export it, that will help an enormous amount. And we're going to be, just like we're the biggest natural gas producer in the world right now, we're going to be the biggest oil producer at some point in the future.
So are you buying those
domestic
oil? Are you buying those domestic oil producers now in anticipation of what might happen?
No. I do think in the short run, oil is going to go down because we just have too much supply and we can't export at the moment. And there are going to be people who are going to oppose that. The refiners, the chemical companies. There are some big interests in the United States that are going to try to delay lifting the export ban for a long time.
Paul, good talking to you. He's talking about Scotland and hangovers, and I don't know, he lost me a while ago. Paul Dietrich, I'm just kidding. Paul Dietrich, Mark Tepper, Larry Schober, we're going to see you for the S&P futures close. Guys, thank you.
Thank you, gentlemen.
Thank you.